Good afternoon, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hopefully all of you are well rested after the long weekend. And in today's markets, guys, well, it was another very volatile and crazy day for the Monday session. At one point today, the SPY and the QQQs were down over 3%, before reducing some of those losses into the close. Now, you might be thinking, well, did we get any crazy bad news over the weekend? Not quite. We did have two pieces of news that came out over the weekend. Number one was the China warning nations against appeasing the US in trade deals. I'll save you the bulk of the article, but essentially what they're saying is if other nations were to broker trade deals with the United States in terms of excluding China or restricting flows in and out of China, that China would have its own retaliatory response to those other nations. Number two piece of news over the weekend was more frustrations with the between the Trump administration and Jerome Powell. Essentially frustrated because rates are not coming down fast enough. Although the rest of the world are dropping all of their interest rates, the US has had their rates very stubbornly close to still 5%. And that does not sit well with President Trump because, of course, that puts a lot of pressure on the bond market, on longer term yields, especially when the US has to refinance its own debt, but also does not convince consumers to go out and spend money, especially on big ticket things such as homes, cars, appliances, and anything else that requires longer dated financing. Those two pieces of news, though, guys, probably not enough to bring the markets down 3%. If you ask me my honest opinion, what the market is looking for is good news. The fact that there's just a lack of good news in the markets continuously puts pressure to the downside and just keeps the market in this phase of uncertainty that we've been in right now. So no news at this point in time is unfortunately bad news. And you can see how investors and institutions are responding by how much are they attracted to the US dollar and US based assets as a whole. Now, of course, we've been noticing over the past few weeks, there's been somewhat of a flight away from the dollar into other things, a flight from the dollar and a flight from US assets altogether, namely equities and bonds. Now, one and the other go hand in hand. The bonds, the equities, and the dollar, right? It stands to argue if you want to buy US equities and or US bonds, well, you're going to need dollars to do that, especially if you're a foreign nation that has a foreign exchange rate against the US dollar, right? You would swap your GBP or your euros for US dollars and then use those US dollars to then buy the US equities or bonds, excuse me. So the US dollar continues plummeting right now at its lowest level in roughly the past 3 years since this same period of time, February, March, and April of 2022. Now, we also saw the damage not only in the dollar, but in the US equities markets. Those have been straight down, and even US denominated bonds, especially the longer end of the curve, the 10 and 20-year bonds, guys, have been consistently coming down over the past roughly 3-4 weeks of time, as there is just an atmosphere of uncertainty surrounding the United States, which somewhat displeases people when they are looking to invest their money, which is why we've seen several other major currencies gain strength against the dollar. Here's the pound, here's the euro, for example. Even the Canadian dollar is now moving a bit higher over the past 3-4 weeks. The move has accelerated to the upside. The Australian dollar and many other currencies are facing somewhat of the same thing. And I truly do believe, as we've been saying on the channel in the past couple of weeks, guys, the market only wants one thing right now. It does not care about the data. Largely, it doesn't even care about earnings right now. It only wants to know what are those juicy deals that the Trump administration has been talking about for the last 2 weeks. What are those deals? Who are they with? And what will be the final resolution? That is the news the market is currently wanting and anticipating right now. And I do believe that until it gets that, they are going to be very volatile days in and out, guys, every single day until we get some more concrete news on those deals and a concrete path for steps to move forward. Because as I always say on the channel, guys, the one thing that the market does not like is just being left in limbo and being left in a state of uncertainty. So that's it for your introduction, guys. Hopefully you enjoyed that. Now, what we're going to do in today's video is quite simply 3 things. Number one, go through one earnings report that I have prepared for you guys from last week. We're going to take a look at American Express and why the company is proving to be very resilient even in this among this economic backdrop right now, right? Number two, we're going to be looking in our technical analysis, our major rundowns here of our major stock market indexes followed by our big tech names. Take a look at those, identify some key levels that could possibly solicit some trades or some long-term investments. And then lastly, we'll take a look at my portfolio for just a few new trades made today. I said initially I was going to go very light this week because of the fact that we have so many earnings, right? It's going to be a very busy week. So I'm going to be saving my buying power for all of those earnings. And hopefully throughout this video, I will regain my ability to speak English because I've somehow been fumbling my words for the last 4 minutes. But I digress. Anyways, let's move into it, shall we? So the SPY down about 2.4, the Q's down 2.47. And overall, guys, it was just a broad market day of selling. I always tell you guys to watch the relationship between the Qs, the XLF, and the XLV, your three major sectors in the market. And when you see all of them, especially like this morning, all clipping into the lows of the day at the very same time, that is synonymous with money leaving the market. It is the lack of rotation that should make you notice these things, right? When you have a red day, it can either be one of two things. Either one big sector is pulling down the entire market. If the other ones are green, that is healthy rotation. A day like today is synonymous with money just leaving the markets, exiting into cash, possibly going into gold, possibly going into other hard assets as well, or just staying in cash. And today you can clearly see lack of rotation on the markets overall. The biggest losers of the day, unfortunately, big tech, but no one else really survived except for Netflix being able to keep up its post-earning gains. Take a look at the one-day relative performance on the group screener. That was Thursday, 1 day relative now. Everything to the downside, unfortunately led by technology and consumer cyclical. On the 1 week relative, we still do have some green in real estate, energy, defensives, and basic materials. But even those on the daily performance today were nowhere to be seen. The entire market was just red as uncertainty still prevails right now. So before we get into more technicals, guys, let us dive into those AXP, American Express earnings. And you guys are going to see they had very, very decent earnings, but now the market has just sold them off anyways. And we've seen that many times so far where companies have had very good earnings. I mean, Netflix was up 4%. They sold almost all of it off. TSM had very good earnings. They sold it all off. And even a month ago, Micron had fantastic earnings. And I'll remind you, they even increased their guidance. Still, that company is down 35% from their earnings. So obviously, people just do not care. They just want to get back in cash, selling assets, selling every single pop until maybe they are provided with a bit more clarity as to where these markets are going. I don't believe that's the right course of action if your time horizon is measured in years and not only in days and weeks. If it's days and weeks, then by all means, you can swing trade these markets and wait for more clarity. But if it's a long-term portfolio, guys, you guys know the drill. Never the best idea to potentially time the market with your entire portfolio, moving it all into cash and saying, I'll just get back in when the times are clear. Maybe psychologically that's the best thing, but you guys know the drill. Statistically and mathematically, that is not the correct way to do things. It's been proven time and time again. I digress. Moving into AXP earnings. They had very solid earnings, guys. Beat on EPS by 5%, and they did beat on revenue by about 0.14%. The best fact of American Express's earnings is the fact that they maintained guidance. We've seen this a few times over the course of the past few weeks, namely with TSM and with Netflix as well, to where those companies maintain their guidance. American Express closely tied into the consumer. Yes, I agree, a more wealthy consumer demographic, but still, they did not taper back their guidance at all. Let's look into the article and we'll break it down. So AXP's wealthy cardholders are mostly untouched by the tariff jitters. Moving on in, younger customers drove growth in the first quarter transaction volumes. That's pretty good. Billed business on Amex cards rose 6% in the period, or 7% when adjusted for the impact of the leap year, which shows the bump in spending late last year continued into 2025. Those trends have continued into April, said the CFO as well, despite sharp declines in stocks this month amid concerns about the tariff policies that will cause a recession potentially. The company's wealthier customer base may help to insulate it from concerns about tariffs and stubborn inflation. On the other end of the credit spectrum, Synchrony Financial, which offers store cards for dozens of popular retailers, has warned of a spending slowdown. So AXP's clients are not, but others are indeed perhaps. Moving on further, there's a lot of stability and strength despite the news and the environment, said the CFO. Growth at Amex came from younger cardholders, with Millennial and Gen Z members spending 14% more in the quarter. Gen X and Baby Boomer cardholders showed more caution, registering 5% and 1% increases, respectively. Now, the CFO said it's difficult to discern whether cardholders were pulling forward purchases because of the looming tariffs, creating an artificial boost to purchase volumes. However, one smoking gun that he did find in the data to determine, well, are people just spending money now because they're expecting everything to get more expensive, or is spending actually good? One of the clues he found was in one of the spending trends here. Restaurant spend was up 8% for AXP cardholders. This is the ultimate discretionary expense. It's not something you can bring forward. And so it's really a good indicator of the strength of our card member base and the confidence that they have. If there was a weak area beside the spending slowdown from older Americans, it was airline transactions. The category grew just 3% after climbing 13% in the fourth quarter of last year. AXP maintained its guidance for revenue growth of 8% to 10% and EPS of 15 to 15.5 per share this year. Both of those numbers are exactly what they guided for last quarter. Take a look at some of the slides right here from their presentation. You will see here a very beautiful net income number. This is 15.2%. That is the top end of the range for American Express. American Express usually posts net profit margins between 13 and 15%. So this is definitely the top end of the range. So nice to see that overall from them. Here's the total build business trend. You can see it's still 6%, which is roughly at the lower end of what they've had for the last 5 quarters. US consumer services build business is also trending down from last quarter, but still roughly in line with what we've been seeing over the past 1 year's worth of time. Commercial services build business, no crazy change in trend there either. And international card services build business, where American Express has been expanding very nicely in the last 2.5 years, is still the best performing segment of the entire business at about 13%. Worldwide total loans and card member receivables, that is also roughly stable, posting a 7% gain when measuring year over year with this same quarter in 2024. And in terms of the credit metrics, obviously American Express differs from Visa and MasterCard in the respect that they are their own bank. They hold the debt. MasterCard and Visa do not. It's a clear distinction that needs to be made. When you have a Visa or a MasterCard, you may see it is a bank-issued Visa or MasterCard. It'll say JP Morgan MasterCard or Goldman Sachs MasterCard, but it will not only say MasterCard, whereas American Express is its own bank. They hold the debt. As such, they will post the same metrics that banks do post. Now, 30 days past due is still relatively low at 1.3%. That's very good. That's in line with pre-pandemic levels. And the net write-off rates as well is relatively good, in line with what we've been seeing over the past 5 quarters. So if there are problems possibly coming, they are not reflected in the data for AXP just yet. And as a matter of fact, their total provisions for loan losses, have they been building up? As a matter of fact, no, they actually reduced the provisions by $73 million overall. So this is the first quarter in now 4 quarters, guys, that they have not built up any more reserves for provisions for loan losses. So apparently they do believe that the credit worthiness of their clients is good enough to afford to do that. Mind you, this is the exact same thing that we saw with the large big banks when they posted their earnings roughly 2 weeks ago. The fact that they were not increasing the total provisions for losses that much, and also the fact that the past due and write-off rates were not skyrocketing at the banks just yet. Now, obviously, this is not any indication of what will happen in the future, but just an indication that the company is pretty healthy right now overall. Net card fees growth is actually up very nicely as well, so that is very good. And the company's net interest income is also moving steadily higher. Very profitable business, very good for them. Are they well capitalized? Yes, they are, as any bank should be. The regulatory minimum for them is 7%. Their CET1 ratio is almost at 11, very good. And they continuously plow capital returns, those juicy free cash flows that they bring in on a quarterly basis. Those are given back to shareholders in the forms of dividends and share repurchases. You can see that AXP, in terms of share outstanding, has been a net buyer of its own shares, at least over the last 10 to 12 years at this point, and continue to do so every single quarter. So fantastic quarter for them. And here's the last little slide I wanted to show you. Restaurants year-over-year growth, that was a bright spot for the company, lodging 5%, and airlines was down to 3%, as the article just said. So overall, that consumer is not being affected by the tariffs so much. So when we're looking for maybe niche plays in the current environment, AXP may be one that is up for consideration. Can it be more resilient than Visa and MasterCard? That's a tough determination, right? Visa and MasterCard obviously have the much larger networks, but American Express maybe has the better clientele in terms of resiliency. So I do believe American Express is a fantastic business in any market, but maybe this market, it deserves a second look if you're looking for something that is more defensive financials. Now, granted, the company has been down a lot recently, but that's also because they ran a tremendous amount in the last 2 years, and any hint of a pullback would have been capitalized on by the bears. Now, moving on further, guys, in terms of the valuation very good here at $250. They're only trading at a 16 forward price to earnings, which gives them a PEG of 1.26. That is pretty good. A free cash flow yield of 6.08%, which is fantastic. Really utilizing that free cash flow well to boost shareholder returns. And comparatively, when you measure against Visa and MasterCard, they only have free cash flow yields of 2.5 to 3.5%, and their price to earnings ratios, although they are larger networks, their price to earning ratios, guys, are roughly twice as high than American Express's respectively, right? So AXP, a decent deal in the market. I really like it. Matter of fact, this little long-term portfolio that I'm starting for the YouTube channel as well, AXP is in that because I do believe they have maybe faster growth in the next 2, 3, 4 years than Visa and MasterCard have. Visa and MasterCard might be more defensive credit card networks, right? But I think AXP has the growth. If I had to pick one of the three for the growth, it would definitely be AXP. Next technical level I would be liking to maybe add some shares would be down here, 232 to about 220, while the company at that point would be down off its all-time highs by about 30%. Quick little thing to finish it off. I'll remind you guys that American Express is no joke for Warren Buffett either. This is his second largest position in the overall Berkshire Hathaway stock portfolio. So keep that in mind as well. If Warren Buffett likes it, maybe it definitely represents or requires a second look from people as well, as they are expanding net margins very nicely and their EPS and revenue growth curves are quite fantastic, all things considered, into the next 3-4 years worth of data. So that's everything I had for you for American Express. Hopefully you enjoyed that. Now let's dive into some charts, shall we? So moving into the SPY, we know that there was a lack of market rotation overall, a very fearful day in the markets as a whole. Taking a look at the fear and greed index, we were at 22 reads for the extreme fear level. Let me just refresh this. As a matter of fact, I think it might be, no, it's exactly the same. 22 momentum, still extreme fear, net new 52-week highs and lows on the New York Stock Exchange at extreme fear levels, and even stock price breadth, right? On a day where you have absolutely zero rotation, it stands to argue that your breadth indicators will be significantly lower. Percentage of stocks above their 20-day moving average is now at a very low read of 22. It can go lower, as we saw a few weeks ago, but historically, this has always been a good time to add to some of your favorite companies, at least when measured across the last 20 years worth of data. You can say the same thing for percentage of stocks above their 50-day moving average, right now at a very low read of only 15% of all stocks above their 50-day EMAs. Now, going back over 20 years worth of data has been a decent time to add amidst all the uncertainty, and percentage of stocks above their 200-day moving average at a low read of 21% of all stocks. That is synonymous with several times where the market has been experiencing a lot of levels of pain over the last 20 years since this indicator has been measured on this chart. So it's a good opportunity, but as I always reiterate and have been reiterating for the last roughly 2, 3, 4, 5 weeks at this point, we have to go slow, right? We understand it's a good buying opportunity, but we have to go slow. If you're a long-term investor, well, it's very simple. 10-15% of every single one of your paychecks should be used to invest in your future, high-quality companies or high-quality ETFs, and embark on a DCA approach rather than a one lump sum trying to time the absolute bottom of the market. If you are a trader, well, you need to understand, guys, that in a time where volatility is very high and moves are somewhat unpredictable because we are relying on different macro catalysts. There's so many things on the table right now, and we know that any day, just a tweet or a press article or anything can move the markets 2-3%. Well, obviously, it's very tough to position in terms of size when sometimes you can't even trust the levels, because the levels can be broken by just overall sentiment and thereafter possible news headlines that happen throughout the day. So if you're a trader, I still do believe that in this environment, my favorite way of doing it is either, well, if you're pure day trading, right? Well, then obviously you're going to follow the trends. But if you're trying to go something for a weekly basis of trade, my favorite way of playing high volatility is selling options below relative tradable bottoms, which are the utmost fear-driven levels that we've had in the market so far. So today I did take advantage of this drop to write some short puts on some of my favorite companies in the market at very, very, very low levels for the Friday expiry. It's a great market to be an option seller, but do not get greedy and follow your rules. Talking about the SPY now in terms of the technicals, well, we knew that we were trying to find if the bulls could complete this daily uptrend pattern. They could not, rolled over, and I was telling you guys, watch out for the Thursday lows. Now we have breached the Thursday lows. We're getting dangerously deep into this support range on the SPY, which is 525 down to 497. The fear lows are still intact, and with such a sizable bounce in terms of the fibs with the tariff 90-day pause, we had a 618 bounce. Well, it stood to argue that the bulls had a very good chance of trying for a weekly trend change. Will they get it? It's still anybody's guess, but one thing's for sure, the bears are in absolute full short-term control of this market right now. No new daily uptrends as of just yet. So when do you know that this daily move down is finished? You need to see a recapture of the hourly uptrend. Only then will you understand that the daily move is finished. Best case scenario for the bulls, they stop the damage here and rework towards the highs and move into resistance 550 to 565. In my opinion, that will only happen if trade deals are published over the coming week, right? This week more specifically, because you're going to need 3-4 positive candles in a row with positive earnings as well. And earnings is definitely not something that we're going to go light on this week. We're heavy all across the board. Tomorrow, a bunch of defense companies, GE, Lockheed Martin, RTX, Danaher Corporation, Verizon as well, Telecom Play, Tesla, ISRG, Enphase, SAP, Capital One tomorrow after the close. Wednesday, another huge day. We also have Moody's here before the open, which I did not mention, but it is there. On Wednesday, Boeing, AT&T, Vertiv, right? We also have O'Reilly Auto Parts. Very interesting for those tariffs between auto parts between Mexico, the US, and Canada as well. IBM, ServiceNow, Chipotle, Texas Instruments, and Lam Research behind my big head. You can see it right down there, Lam Research. And then, of course, Wednesday, or Thursday rather, another big day. More airlines, American Airlines, Intel, Google as well. Big one this week too, right? And so many other large plays to wrap it all off. Union Pacific, Pepsi as well, Merck. We got AbbVie, Colgate, Palmolive, Phillips 66 on the Friday session. So this week, guys, is going to be absolutely nuts with earnings. And there will be some companies there with the commentary on the tariffs that I wouldn't be surprised if it does move investor sentiment to one way or another. So we'll keep an eye out for that. But the, we're clearly right now approaching a daily downtrend. Whether or not we go to the lows, nobody knows, guys. It all depends on the headlines this week. So that's why I say there's 3 possibilities, right? Either the bulls save and we rework our way to the highs and a daily uptrend is possible because we got such a nice weekly bounce in order. Or one of the other case scenarios is you just devolve into some form of an awkward, volatile range between resistance and support. And the worst case scenario is the leg number 3 completion pattern by the bears, which could send us all the way down here, 475 to 445 on the SPY, which will be coming into the 200 weekly EMA and the 2021 highs for the markets. So a lot of moving parts, guys. As I say, I'm not trying to predict the direction. I will let price action guide me. And for now, while the bears are in short-term control and we are approaching hourly oversold conditions, it's a good attempt to sell options, sell puts below the lows, but I'm not going to be the one that's going to call this the bottom and go for a swing trade on call options or buy put options from here and try to go for the lows. There's just too many moving parts, too much volatility. And when that's the case, when I don't have clarity for direction because the macro is unclear as well, I'm a big fan of just selling the volatility. Moving on to the Qs. So the rest of these should be fairly easy because I usually do my whole rundown with the SPY. The Qs, same concept, however, flushing the lows. So now we do have a confirmed daily downtrend into the depths of support, 447 down to 441. That's not good. Number one, well, because we had such a very nice weekly bounce on a weekly downtrend, of course, very nice weekly bounce. You're looking for the bulls to set a weekly higher low and go for a possible trend change. Well, unfortunately now, daily downtrend, and they have cut very, very, very deep already. So one of three things is going to happen. Either the bulls can put in a stop right here with some positive headlines and attempt the weekly trend change, pushing into resistance 478 down to 466, or we go into some form of a very awkward, volatile range using the fear lows as our maximum fear proxy. Or the worst case scenario is the leg number 3 down on the charts overall. I know it looks like that. It definitely looks like, yeah, for sure, 100%, we're going to go down there, but it's not so easy, guys, right? You have a lot of headline risk that could turn the tides intraday and breathe some life into the markets overall. We know that Trump was looking at the bond market down here for a little bit of a Trump put on those tariffs. If we come back down there as well, and the bonds also start eroding as much as they have been in the last few weeks, maybe we get some further commentary out of the White House, which stops the bleeding before you can make significant profit on that downside. You got to be very careful, which is why I say my favorite way of doing this right now, when I'm not trying to predict the markets overall and the price action is somewhat a little bit tedious because they're very, very wide and volatile moves. Sometimes the best thing to do is sell that volatility by writing put options on your favorite companies or ETFs well below the markets at levels that you don't mind being assigned, also at levels where the support is more clear, such as 400 to 370, 200 weekly EMA, and you also have the 2021 and 2023 resistance highs to kind of play off of rather than trying to play in no man's land. Moving on to the XLF financials right now, banks not performing too well either, 2.14% to the downside. Not quite flushing, guys, right? This is a clear daily downtrend, yeah? Nice bounce, a little higher low, higher high, and now coming down. So we're looking for the bulls to save this and make another attempt for daily uptrend continuation. Anything above the lows of Thursday, 44.60, are going to be looking for a higher low for possible second or rather third attempt at going through this resistance range. Now we are into one level of support, 45.78 down to 45.07. But if you look on the weekly time frame, it's also not so simple, right? Nice bounce, but the bears are starting to claw a little back. Now, because of the size of this bounce, as I've been saying on the channel, guys, 618 bounce, the bulls have a chance, a very decent chance. But if we do not get any positive headlines, then it's just going to be more of a fade to the downside. Maybe the VIX won't go crazy again, but lack of positive news, you can clearly tell the sentiment is bearish already. At that point, if they do breach this level, we're coming down below here, 44.05 down to 43.44 overall. I'm interested in the banks, but overall, I want them low. If Bank of America drops a little bit, perfect. I'll write some short puts down there. If Wells Fargo drops a little bit, perfect, because they're in a weekly downtrend. I'm not saying, well, I'm not going long here. I'm not going short here into resistance either. I will be looking to buy the dip in the intermediary using short puts well below the market on a weekly basis, because I don't want to anticipate what's going to happen beyond the next week because the data changes so rapidly every single day. Moving on to XLV right now, same concept, 2.16% to the downside. And right now, right, in jeopardy of losing the entire daily uptrend attempt. Anything below 130, that would be a categorical new daily downtrend and would just perpetuate this weekly downtrend that the bears have already, proceeded to realize on this ETF overall. Now we are coming fairly deep into this zone of support. 126.50 is pretty much the last line all the way down there. That is literally 2 years of support and or resistance, right? Resistance highs, support lows. For the XLV bulls, we'll see if they can defend this a little bit better. We have a few large players coming in to motion this week, namely AbbVie, big pharmaceutical company that will be reporting, and healthcare, known to be one of the more defensive sectors. Well, it's going down a lot because companies like UNH just perpetually keep dropping right now after their earnings. This is one of the biggest sell-offs this company has had in the last 25 plus years at this point. Nice that they're coming into support, and several of the companies are coming into oversold conditions quickly, like AbbVie's already there, but they have their earnings. The market got a nice boost last week from Eli Lilly, but even Eli Lilly, after last week's trial news came out, even they started fading a little bit. And you can see, even though healthcare is a fairly broad sector, right? You got healthcare insurers, you got medical devices, you have drug manufacturers. Every single aspect of that sector was down today, no rotation to be seen. Now, moving into semiconductors. So semiconductors continue to be in the firing line of the markets right now. And unfortunately, them too have flushed the lows of Thursday. So we were looking for a possible daily uptrend continuation, did not get it. And now we have the lower highs and the lower lows. So daily downtrend is now in motion. As I said, we were looking for the weekly bounce. The weekly bounce was very nice overall, but a bounce is only a bounce until you change the trend. 618 bounce, and now it's up to the bulls to prove it to us. Can we defend these lows, set a higher low in motion, and go for a weekly trend change, or will we just perpetuate more of this weekly downtrending cycle into more extended monthly consolidation, culminating in the level that I like the most, which is down here, 161 down to 140. It is the area of congestion of the fall sell-off of 2023, and coincidentally as well, the highs of the end of the 21 bull market overall. So semiconductors at this point, they're really, they have to get their butts in gear. In other words, guys, the market cannot do it. This was your lead bull for the last 2 years. Now they've transformed into a lead bear. The market will not recover if we do not get semiconductors back. They're too big of a weight in the index at this point after the last 2 years to just be left on the sidelines while everything else runs. So please keep that in mind. How do you know that the daily move down is finished? Quite simply, as I was saying on the SPY and the QQQs, look for the hourly trend changes. If you do not get a new hourly uptrend, you cannot say that your daily lows are set. And then again, we just be looking once again for lower high. How high does the bounce get? And can they change the trend after that? Because right now we have nothing anymore. We have no weekly uptrend. We now have lost the daily. So now it's up to the bulls. Where can they put in a stop? And can they give us a nice enough bounce to change that, set the weekly higher lows, and go for a possible trend change into resistance 215 to 232. Moving on to the Russell right now. The Russell also challenged today 2.01% to the downside. Lows of Thursday still intact, so no new daily downtrend on the Russell just yet. Just a little bit of a downswing formation. Pay attention. The Russell is also trapped between two levels as the rest of the market is too. 200 down to 188 is the resistance above. Very strong level, guys. Support, resistance, support for the markets, very big level. And below us, 180, roughly down to 165, is going to be the lows of the 2022 bear market overall. The Russell is not the place that I want to be in right now in this market. And, in relation to that, this sector also had one of the weakest bounces. So if the SPY and the QQQ cannot even hold up their 60, 70+% bounces, well, dare I say, maybe the Russell is not going to be able to hold up its own respective only 38% bounce. The likelihood of a retest of the lows or possible rollover is quite high. So keep that in mind for the Russell. Definitely a very challenging trade overall. And now lastly, the Dow Jones. Dow Jones down 2.5%, flushing the lows of Thursday. That is it. Your higher lows and higher high pattern has been broken. No more daily uptrend attempt possible for the bulls. It is now a equal high roughly and lower low. That is a new daily downtrend into the depths of the lower end of support. 38,000 up to 39.1 is your support range. If you keep flushing, guys, I'll remind you, right? Who's in control right now? The daily bears and the weekly bears are also in full control. This was a very nice bounce attempt, but a bounce is only a bounce until it's followed up by a trend change. Always keep that in mind. So keeping that in mind, right? How do we know this daily move down is finished? Well, similar to everything else, you need to get an hourly trend change in motion. No hourly trend change, your bears are just going to keep on running with it. Then when we do get a bounce, you're looking for a lower high. How high will that lower high be? That will give you the impression as to whether or not they can recapture and put an end and maybe go into a weekly uptrend attempt. Or are we going to devolve into some form of an awkward, wide, volatile range, or come down and flush the lows? One thing's for sure, if they do flush these lows here, 200 weekly EMA, very nice area that the bulls like to defend on every single touch. So keep an eye out for that one. And this would be the highs of 2023 and 2021 combined top to bottom. If we do flush, the worst case scenario, that would be 18 to 20% bear market conditions for the Dow Jones. That's everything for your major sector rundown. Take a look at the VIX. We were saying all last week on the channel that even though we are not at the highs of uncertainty anymore, the VIX, the volatility can still stay quite elevated. Today was another proof of that same fact. You can go back in time, and even though August, this was an anomaly, going to 60 and then pulling back all the way down to 20 in just 2 weeks. Usually it doesn't work out like that. What does usually happen is a bear market like this, the volatility stays elevated, 25 to 35 for quite some time. Even after COVID, you see how long this volatility stayed elevated, right? Almost a year. And even if you go back a bit further, put this on the weekly time frame, you can go back, guys, even to 2008. 2008, the great financial crisis. Yes, you had the initial spike up to the 60 level, but then it stayed very sticky for a very long time. And even the flash crash of 2011 was the exact same thing. So I maintain my thesis that the volatility, although we may have hit a short-term temporary peak, could be somewhat sticky between the mid to high 30s and the mid to high 20s as we continue navigating through this environment right now. But it's a great opportunity to benefit from being able to sell options a lot lower than you otherwise would be able to in a normal market. Moving on to the yields, well, the yields continue pushing higher, guys. 10 and 20-year yields, the 10-year up 2%, the 20-year yield up 2.25% overall. I will remind you guys that this is when the pause of the tariff came on. It gave us some nice relief, but now we are right back up almost to 5%. That seems to be where the Trump put is at this point. We will see if further commentary comes out of the White House, if that does happen over the next few days. But one thing is very, very clear right now, guys. A lot of uncertainty around the United States, its economy, its administration, its trade policies, which is leading people to not be attracted to buying longer dated bonds. Short-term bonds, such as the SHY 1 to 3 years, yes, because people are expecting rate cuts to come into play this year and next year. But if you're a foreign investor wanting to lock in your money for paper, not an ETF, but the actual paper for 10 or 20-year bonds, maybe you want a higher risk premium, meaning a higher yield because of all the uncertainties associated with the US economy right now. Maybe your longer-term view of the US has been soured by what's happening, right? I'm just putting in perspective what other nations may be thinking, which is why they may not be flocking to US equities right now, nor US bonds. And you can see that for the demand for dollars. That's all the DXY measures, guys. Sure, you can go into currency controls, you can go into trade policies, you can go into fiscal measures, you can go into debt measures as well. But at the baseline, is there a higher demand for dollars now than there was just a few short months ago when everybody was super bullish on Trump's term and everybody wanted to buy US equities and US bonds? No, the demand for dollars is less than then because there is more uncertainty now. And that's how you should interpret this chart as well. Don't try to get ahead of yourselves with the analysis or whatnot, guys. That's just the way the bond market is moving right now. A testament to uncertainty, a testament to the spread between the 20 and the 2-year bonds and the 2s and the 10s as well, getting extremely high right now, putting a lot of pressure on those basis trades, the swaps as well in the bond market overall. And the so-called carry trades additionally. So a lot of moving parts on the bond trade, guys, overall. Now moving into gold. Gold also had one of its, continuing to have one of its strongest rallies at this point, guys, since the 1980s in such a very short time span, which just goes to show you, right? Any USD denominated asset is proving to be a very good investment right now. We'll get into Bitcoin in a little bit because there's one chart that kind of stands out to me, but gold as well, right? Gold overbought conditions right now. Daily uptrend is now still relatively clear as day, right? Just a straight shot higher right now. Eventually, you will be looking for a bit of a move back into the 12 EMA. The 12 EMA should be playing catch up roughly around that 3250 to 33 level. But the next stop to the upside, of course, definitely has to be that 3500 psychological level on gold. No trades for me as of right now. Just monitor this hourly time frame overall. When you lose the hourly time frame, such as right here, you know that daily consolidation is underway. And then you're just looking to see how long will that consolidation last overall. Very tough for anybody to enter this trade right here. You, at this point, if you have not bought gold at any point in time throughout this, call it a crisis if you want to. If you're buying up here, guys, is the risk higher on gold up here or lower? The risk is higher, right? It's lower when the price is lower. Buying gold up here, you're really preying, on some short-term calamities to happen because central banks and institutions have been loading the bag on gold, and it's never a good opportunity to get in behind them with such size at these higher levels, right? So be very careful with how you are trading gold overall. That's just my take, but a phenomenal asset in its performance recently. Moving on to Bitcoin. Bitcoin has come alive a little bit, guys, but there's a few contradicting signals on Bitcoin as of recently. Number one, of course, you have to notice the inverse head and shoulders. The only problem is that with this new leg of expansion into a new daily uptrend with the pop today, well, we're coming unfortunately into our resistance zone, right? So 92.5 down to roughly 87. Let's call it 93 to 87. Big support. Now big resistance for the markets as well. So it's unfortunate that although we're getting some bullish trigger signals, such as a new daily uptrend, such as the inverse head and shoulders, right? Such as the weekly MACD seemingly wanting to curl over and set the new weekly uptrend, it's unfortunate that we are kind of right into resistance. However, there are a few key things that we want to notice here. Number one has to be the Bitcoin versus the gold chart, right? So Bitcoin versus gold overall is proving to be somewhat of a resilient trade. You can drive some form of a trend line right here and say like, okay, well, we're clipping into some, I mean, it's not the perfect trend line, but you guys get what I'm trying to say here, right? Bitcoin versus gold. Can there maybe be a little bit of a catch-up trade here on Bitcoin versus gold? Possibly. That doesn't mean that gold has to go down. It just means that Bitcoin has to go up faster than gold were to rise, because never forget, Bitcoin is a US dollar denominated asset. It stands to argue that Bitcoin has many faces. Sometimes it's an inflation hedge trade. Sometimes it's a risk on asset. Sometimes it's a pure speculative casino asset. Sometimes, as of right now, it actually does what it's supposed to do, which is a cryptocurrency. Clear focus on the word currency. I showed you the currency charts earlier. Everything against the US dollar was appreciating. Now, is Bitcoin maybe finding some of that investment? Sure. You can say that maybe it's Michael Saylor buying, maybe it's institutions buying, maybe it's BlackRock, maybe it's the ETFs, maybe it's Trump and his close surroundings. It does not matter, guys, where the buying's coming from. We just have to notice that a few key things are diverging from where they were before. BTC versus the dollar as well is the same thing. You can see a clear expansion here as the dollar loses and Bitcoin appreciates against the value. If that chart is not clear enough for you, you can always overlay BTC against the DXY and see the divergence that I am talking about. Bitcoin has largely followed a similar price cycle to the dollar, meaning that it was correlated with the S&P 500. It was correlated with other assets. If they were going up, crypto was going up as well. And now you see, since the US dollar was flat or down, Bitcoin was flat or down, downswing here, since the dollar was downswinging since the month of February too, but now we have a decoupling in that relationship, right? A decoupling. You can clearly see the Bitcoin has moved higher in the last 2 weeks and the dollar has moved lower. So now, out of Bitcoin's many faces, Bitcoin is actually acting as a currency, and all trades moving forward on Bitcoin should be interpreted from a currency standpoint using its correlation to the dollar. When Bitcoin is performing like a risk-on asset, then you have to correlate it with risk-on assets such as the Russell or the QQQs, right? When Bitcoin is moving like a currency, then you have to correlate it versus moves in the dollar. That will give you the most success in your trades right now. Hopefully that was insightful for everybody who likes to trade crypto out there across Bitcoin's many faces. Always important to recognize which face is Bitcoin adopting right now, rather than just viewing it overall with too many different data sets, right? You have to identify what is Bitcoin, what is the narrative that Bitcoin is following right now, and that's the one for me. That's it pretty much for our market analysis rundown. Now let's dive into our big tech names. So moving into Apple, guys, we're going to focus purely on the technicals because by now you know how I stand on all these companies fundamentally at this point. So purely technicals at this point in time, guys, very simple, right? The lows of Thursday are the benchmark right now. Daily uptrend was set by Apple into resistance, looking for a daily higher low, coming down into support, 196 down to roughly 186. Pay special attention. This is the expected move. This yellow line, we hit into it today. That was 189.55 before bouncing higher. Apple protecting these lows as best as it can in the context, of course, of this sweeping weekly downtrend with a very nice bounce. The bounce gives the bulls the best opportunity as it is a 75% bounce roughly. It gives them a very good shot, guys, at trying a second attempt and going for that weekly trend change. But of course, trade policies and trade deals in terms of market headlines is what Apple's going to need to start breaking above. If not, we may devolve into some form of an awkward, very volatile range, the bottom end of which is, of course, the fear lows, standing at 177 down to 161 around the 200 weekly EMA. If I am writing short put options, which I did today, I am targeting these fear lows on Apple, which consequently are the lows of 2023 and the highs of 2021 overall. So moving on to AMD right now. AMD down about 2.22% today, flushing its own respective lows of Thursday following semiconductors in that respect. So loss of a daily uptrend attempt after top-down analysis, right? Weekly downtrend clear as day. Everybody knows that, yeah? The lower highs were set into resistance, which at this point was 113 down to about 97. So now that you know that the weekly bounce is done, how do you know it's done? Because now we've lost the daily uptrend, right? So now the bulls are looking to play some defense around these fear lows, which are currently, the lows of the fear candle, 77.43. More specifically, though, the support zone. It's 83 down to 64 overall. So if you're looking at this on a day-to-day basis, wondering when the bulls are coming back, well, the analysis starts on the 1 hour time frame. Give me a new 1 hour uptrend, then you know the daily downswing is finished. Now you need to know, as additionally, they need to put in a good bounce like they did back here. Give me a good bounce, that'll be a lower high. Then can we change the daily uptrend? Then you will know, okay, the weekly lower highs are set, and maybe we can actually go for a weekly uptrend. Until any of those things happen, the bears are still fully in control, and the most efficient way of trading this stock would be to sell short puts well under the market instead of counting on a direction right now without confirmation. Moving on to Amazon right now, same concept, right? The lows of the Thursday session were broken. So big move, nice engulfing move. We start on the top-down analysis. It is as follows. Weekly downtrend is clear as day. Very nice bounce on Amazon overall. That was a bottom to top bounce of 61% overall. Very fantastic bounce on Amazon, but now they're giving a lot of it back. Can the bulls step in and possibly go for a weekly trend change after earnings or a tightening range, wide range of accumulation rather? Sure, but as of right now, the bears are in full control, and until that changes, right? Well, we cannot forecast out that far. Daily downtrend is well in motion. How do you know the move is done? Hourly time frame, guys. Watch for the hourly trend change. You will know that your daily lows are set. Since it's a daily downtrend, you'd be looking for a lower high in relation to this high, right? Lower high, then depending once again on the size of the bounce, you can then gauge if the bulls have a chance of resetting into a daily uptrend and getting some form of a weekly uptrend going, or if the bounce is very weak. And then on the lower time frame, the hourly, they got up to here, then they roll over. That would mean your daily bounce is finished with only a weak retracement up. You know the likelihood of continuation is higher, right? So keep that in mind. The whole time the bears control this 1 hour, it's just going to be down, 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 and you're targeting the fear lows at this point, 161, into the overall area of support. The 200 weekly EMA is 158. This whole support area is all the guys from 2021, culminating in about 145. Moving on to Google right now. Google has their earnings on Thursday, so going to be tough to derive some price action, but we can try. Top-down analysis. Weekly is a clear weekly downtrend. The size of the bounce on Google was pretty adequate at around 618. Now, that bounce does not guarantee a trend change. It only guarantees a chance. So looking at the daily right now, you can clearly see daily uptrend was set, but now we've lost it. We've flushed the lows of Thursday. So now the bulls have to start everything from scratch. I need the hourly uptrend first. Then I need a daily bounce, decent one. Then I need a trend change. And only then can we say, okay, the weekly lows are set, and maybe we can go for a weekly trend change attempt into the resistance highs 175 to 163. Until that time, the bears are in full control right now. Now we're coming into support 149 down to roughly 135. If I'm looking to play this stock, I'm looking to write short puts well below the market. Keep in mind, though, this week they have earnings, so you may want to have a little bit of a pause until Google releases their earnings overall. That's the analysis for Google. Everybody knows it's very cheap. Most of these stocks are very cheap, except for Apple. We'll do the fundamentals once every 2 days, but now I want you guys to focus on the technicals and not get ahead of yourselves. Do not predict. Understand who's in control. Meta, same concept. Who's in control of this chart right now? Top-down analysis. It is the weekly bears. That is just a fact, right? We had a very nice bounce, but as I always say, a bounce without a trend change confirmation is only a bounce. We had a almost 75% bounce on Meta. It was looking good, but unfortunately, a lack of good news has just unraveled the entire move at this point. A very attractive bounce, and now just fade the entire move. It doesn't look like much, guys. From the top to there, that is literally 18% straight shot down in about 7 days worth of trading. We have now flushed the lows on Meta. This is the first stock amongst its sector peers. If you take the Mag 7 without Tesla, the ones that have been in fairly good monthly uptrends, right, so far. First one that's actually flushed and cascaded below the lows. So at this point, weekly downtrend simply continues, looking to the bottom end of support to act as a last barrier of defense right here. That would be 450 on Meta overall. Everybody knows it's cheap right now. I don't need to say it every video. I will, though. Right now, Meta is going to be 10% under this, under a 20 forward price to earnings. So long-term portfolio, yes, guys, yes. For a lot of these companies, the answer is yes, but slowly. Short puts, you guys know the drill. Go very low, below the expected move, and on a weekly basis. Moving on to Microsoft right now. So Microsoft down about 2.35% on the day. Top-down analysis is the exact same as the rest of the market. Who controls this? The weekly bears. We had a 100% engulfing move, and even a 100% engulfing move on Microsoft seems as though it was not enough to deter the bears as of right now. So that being said, taking a look at the daily drill down right here, we had a nice daily uptrend attempt into resistance 393 up to 408. However, now relatively equal highs and the lower low means that we are now in a daily downtrend. That means the bulls are looking for a higher low to possibly go for a trend change. Now that could devolve into some form of an awkward range. It could also translate into a weekly flush of the level, but overall monitor the short-term price action. When do you know this daily move down is finished? Go back to the basics. Hourly uptrend. When the hourly uptrend happens, how high is the size of the bounce? Because you know, it's going to be a lower high, right? It's probably not going to be this. It can be, but it's probably going to be a lower high. How high does that bounce get? Then can they transform it into a trend change, right? That's what we're looking for. If they cannot, and the bears just engulf as of right now, we're going to the fear lows 345. Below that is a nice area of support is the 2021 highs, the 2023 full period sell-off lows, and that is 345 down to 323. Microsoft, a fantastic company, needs no introduction, should be part of a long-term portfolio, but right now the bears are in overwhelming technical control. Moving on to Netflix right now. Netflix actually a bright point in the market as it is acting as one of those kind of defensive stocks out there. There's only a few of them right now that seem to be holding up better than others. One is Netflix, the other seems to be Kroger, right? Some of these quote unquote consumer essentials. Apparently Netflix has made its way into that category right now, despite not being labeled as such. That's definitely how the market is treating it, right? Got to just notice what the price action is doing. So that being said, Netflix is actually one that is still in a very nice daily uptrend right now. If we're looking for a higher low, it's anything above the lows of Thursday, 893, looking for a daily higher low for possible further trend continuation. Now this is a level. I wouldn't say it's a strong level, but it is a level, 970 down to 953. If you break down through it, even though it's not even there though, we do have a bigger level, which is this zone right here for the bulls, talking about 935 down to 900. We will see if Netflix can continue on doing it. But one thing that Netflix did better than most is now they have a 100% weekly engulfing move. So now the bulls have created a lot of space to kind of make this their own. And it doesn't look like much, guys, but this has been an area of awkward consolidation now since last November, right? Sure, we made new highs and we made a bit new lows in there, but overall, it hasn't been a trending market, right? It kind of stopped that after we started selling off in February. Now we're kind of trying to get it back, but Netflix looking good. Long-term portfolio, yes, but nibble, because as we covered on their earnings last week, the valuation is not very cheap right now. It is, as a matter of fact, quite expensive, but people are willing to pay this valuation for a little bit of certainty of earnings, I assume, right? Moving on to NVIDIA right now. So NVIDIA down 4.51% after there was some news today that, well, you can see right down here, NVIDIA must now secure licenses to export its H20 chips to China. That was news that came out last week. As per the regulations for licenses, it was unclear. That got clarified this weekend. But also, Huawei, right, came out today saying that they already have the AI 910C chips, which are rivals to the NVIDIA H20s, to replace them immediately. So that's why NVIDIA was down it was over 6% at one point today, but now ending down 4.51. So NVIDIA, guys, a very good company, but I've talked about this many times in the past, right? There's a lot of things affecting NVIDIA right now. Sure, the tariffs, sure, the trade relations between the United States and China, but also, and more specifically, what not many people seem to be realizing right now is the refresh cycle of their data center products, right? Their EPS is it's not expanding exponentially anymore. It's curling, right? It's still growing, but the growth is doing this. It's tapering off. Look at the revenues. The revenues are tapering off. It's still a fantastic company. They have a large competitive advantage, and the company's not going anywhere. But when you're talking about explosive growth, NVIDIA does not have explosive growth anymore. It has more normalized growth as the revenue goes like this now, and the EPS also is starting to go like this, which leaves people worried about what's going to happen to NVIDIA's purchasing power beyond 2027. Nobody's saying that they don't have good products. It's just when you're trying to model the valuation that you should pay for a stock, that's what comes into a problematic concern. Moving on further into the technicals, guys, top-down analysis, it's very clear who's in control here, right? Weekly downtrend, very nice move by the bulls. That was a 78% retracement. It gives the bulls the best chance of trying to go for a weekly trend change. But as of right now, the bears have now engulfed again, cracking below the lows of Thursday. Daily downtrend is now set again. We'll see if the bulls can play defense, somewhere before the fear lows, which are currently standing at about $87. And it all lies in the hourly trend changes, right? Hourly uptrend, perfect. That means we got the daily lows. Then measure the size of the bounce. You can get a nice bounce. You can get a trend change. You get the trend change. You can officially say the weekly lows are set, and you can, base a trade on the premise of going for a new weekly uptrend. Other than that, the bears are still in full control. What's my favorite way of playing? Something that has uncertainty and unclear price action trapped between resistance and support. You guys guessed it, selling puts well below the market on volatile days such as these. Moving on to Tesla. Tesla's earnings tomorrow, guys. So it's going to be impossible for me to derive any form of predictions. Not that I do anyway, but when Tesla has an expected move tomorrow of like 9-10%, well, it means that anything I say today can pretty much be thrown out the window by tomorrow, because we know Tesla's going to move. Maybe it's going to, the expected move is 9, but in all reality, I think everybody expects Tesla to move probably a bit more, right? So Tesla moving into tomorrow, if we get 9% to the upside, we're right back into the resistance highs, 260 up to around 300. And if Tesla moves, excuse me, my nose is itching. If we move down below here, 10%, right, or more, well, you're coming right into support. So we're kind of trapped between the resistance range and support. I would rather just wait and see and give you guys the expected move. Now, there is one way that you guys can possibly trade this. And if you take a look at, let's say, the options chain, I was saying if anybody wants to play earnings in a somewhat conservative way, Tesla's offering some ridiculous premiums to sell puts in the market right now. Take a look here at your weekly puts. I'm not saying to do these. I'm just saying for people who are interested, a very easy way to benefit from the volatility is maybe writing something like a 140 put for 31 cents. Right? You're not really playing direction. You're not trying to buy calls, buy puts, and just go for the Hail Mary trade and just guessing the direction on what you believe is going to happen to earnings. This is just someone who's locking in 140 as a level, collecting $30, and it's significantly far away from the current price, right? Like 140 away from Tesla right now is crazy, right? I guess you can assume that's 38% by Friday. Can it happen? Sure, anything can happen, but that's a 2 delta trade. The odds of that happening are 2%, so keep that in mind. Those are my thoughts on Tesla. We will analyze their earnings together on the channel tomorrow after the close, and maybe then we can get some more clarity as to how to properly position. But I do not want to, predict the move that Tesla's going to do tomorrow, because once again, that trade is a lot of moving parts, guys. It's short-term negatives versus long-term positives, right? It's the push. It's kind of like the US right now. It's kind of like the US markets overall, right? Short-term negatives versus long-term positives for the US. It's the same thing, right? So if I can't derive clarity from the entire market, well, it's very tough for me to derive clarity with Tesla myself, because these are two very separate trades with very different entry and exit criteria. Moving on to Palantir right now. Palantir as well, down 3.18% today, but holding up better than most. I like Palantir's price action as of recently. Doing very well, right? Try to set up the daily higher lows and go for the possible continuation of the daily uptrend. If you crack, as you almost did today, 89.53, it's a daily downtrend, sure, but look where we were left off from, right? This is a nice weekly engulfing move. Weekly downtrend, 100% engulfing move. The bulls have a lot of space and nice support below. Any move down, looking for a higher low, anything above 67, looking for that higher low for possible trend expansion. Possible, not saying it will, but possible trend expansion. Or maybe worst case, we just devolve into some form of an awkward, very volatile trading range with supports below us, 83 down to roughly 77.50. And the second one is down here, 72 to 64. That's where the bulls said, nope, no more. We're buying. The first time we got into there at the fear lows. My favorite way of playing this one is not going for the moonshot into uncertainty, not going for the absolute put play, saying that Palantir is going to go back to zero because it's so extremely overvalued right now. No, I'll just look to sell puts below the market and play the volatility in either way. Moving on to SOFI right now, down about 2.64%. Not the worst day for SOFI, but definitely not a green day as it got brought down with the entire market. Top-down analysis is very clear. Weekly downtrend still in motion right now. Decent sized bounce. SOFI didn't have as incredible of a bounce as other players out there, but it was a 50% bounce overall, and the bulls seem to want to hold in or around this support range, which is roughly $10 down about $9 overall. It's this whole area from the IPO leading into the highs of 2023 and 2024. On the daily price action, also very tight, right? You got to pay special attention to the lows of 2 Thursdays and Fridays ago. If we break those lows, daily downtrends in motion, and you look to the bulls to kind of try to set up for a higher low to go for the weekly trend change. If not, you'll be revisiting these lows or very close, at which point I'll be interested in selling some puts down here below the market. SOFI valuation is good, but just the short-term price action is somewhat unclear as we're kind of somewhat in a tightening range. It looks good. If the rest of the market can pull itself together, I wouldn't be surprised if SOFI expands, right? But I'm not going to get ahead of myself and position very heavy for that. Moving on to Uber right now, down an additional, or not an additional because it was up on Thursday, but Uber down today 3% overall. Not the worst day for Uber. The higher lows are still from 2 Thursdays ago after the tariff move, right? Daily uptrend is nice. Looking for the daily higher low at this point. Anything above 68.41 is just looking for that daily higher low. Not too bad of a move, looking into a possible inverse head and shoulders pattern for Uber as well. The highs of that move would take us up to the 77 to around $80 range. And right now we're kind of back testing support overall, 73 down to 68. Comes a little bit lower. I'd be interested in selling puts down here, especially with the VIX high right now, but in the middle of a range, right? Between here and here, it's kind of an awkward position. It's fine if you want to use the lows of today or Thursday. To me, you know, if you use the lows of Thursday, unfortunately, it's a 1-to-1 trade, right? Longs into here and the stops below there. So you'd have to have a tight stop loss to improve the risk to reward profile a little bit on Uber, but it's not looking too bad at all. The valuation is still quite good down here at around $70, which is about a 1 peg with a decent free cash flow yield. And now lastly, TSM down about 2.61% overall. Not a terrible day for TSM, guys, but they did have really good earnings, and it's unfortunate to see them come down after such good earnings. They've really been following the semiconductor industry as a whole, and unfortunately, that does mean that, you know, as of right now, the higher lows of 2 Thursdays ago have now been roughly breached to the downside, which is always unfortunate. An unfortunate look by the bulls. You know, you can argue that this is another one after earnings, sure. But overall, you know, if we're taking a quick glance at this, you just want to see a clear trend. It is a daily downtrend, whether you take this high to this high and then down, or this one to this one to this one. All things are saying the same thing. It is a daily downtrend right now with the highs in or around this level. So you'll be wanting to watch two key things here. How do we react from the first line of defense, 147 to 138? Can we get an hourly uptrend in motion? Can we get a very nice bounce by the bulls to really start engulfing or two-step recovery into resistance, which is 171 to 156, which would put an end to this most recent third or even fourth leg of selling, looking for the weekly higher lows for some expansion. It looks nice. A lot of stocks look nice for that, right? But the lack of news or positive news or more semiconductor news is just going to kind of weigh these to the downside. And if that is the case continuously, I can get some good levels down here, writing some short puts, 130s to 120s. I'll gladly take it. That's the 200 weekly EMA and is the highs of 2020 and 2021. And the valuation right now, we did it after earnings, guys. It's very cheap. It's very cheap. Sure, there's a lot of geopolitical risk right now around the company. China invasion of Taiwan, which has been, you know, front and center in the tabloids once every month for the last 7-8 years at this point in time. That's been an overhang. But right now, the tariff risk, et cetera, you know, it can bring the stock down into here and nobody would be surprised, right? So that's why I'm being very careful on TSM and writing puts down there. But I continue to add shares in TSM to my long-term portfolio due to the valuation alone, because my long-term portfolio, quite simply, guys, is measured in question of 5 to 10 years plus, and not just days or weeks or months, right? That's what I'm thinking about. Not so much what's going to be the potential local bottom, what's going to be the absolute bottom, are we going to a recession or not? I'll buy the entire time that the valuation is cheap and does warrant me adding to the position. That's it. That's all. It's the Warren Buffett approach. No more, no less, right? It's the value investor approach overall. So that's everything I had for you guys today. In terms of the trades, I mean, the portfolios are the exact same, guys, since pretty much last Friday when I showed it to you guys. So in the sake of saving time for today, tomorrow I'll probably do a lot more trades and show you an updated portfolio. But just, there was only 2 trades made today. Nothing fancy, right? I'll show them to you right now. The only 2 trades that I took today was the Amazon 152.5s in the morning for 34 cents, very early, 9:33 a.m., 0.25% for the week. Bear market strategy was in the top 5 options play of yesterday. And also the Apple was also top 5 options, 175 strike for Friday, 46 cents, 0.25% for the week. Very conservative. I closed a TQQQ play for about 75% that we had open. The only other thing I did was like write some covered calls against my ELF. My ELF position, a 59 strike for 35 cents. My ELF position now, we brought the cost basis down to 57.75. Quite happy with that. Those are the only trades I took today. I'm saving my buying power for earnings. But I mean, the stocks that I showed you guys in the top 5 options list, right? Like they were all here. These are all the ones that I gave you guys yesterday. Yeah. All of them and even more were all up for grabs in the market today from yesterday's video. So many of them, you could have gotten some juicy premiums way below the market for Friday. So hopefully you guys are able to benefit from today's volatility, from today's declines, to just kind of put the emotions to the side, put the forecasting and prediction to the side, and trade like an algorithm, guys. Identify a level, as we do in the top 5 options videos. Yeah, identify a level. Is the delta low enough? Does it respect the strategy? Is the ROI decent? Do you like the stock? Do you like the level? If all conditions are met, right, we take the trade. We're not going to sit here and think, well, what if this happens this week? What if this happens this week? What if this happens this week? What if the stock goes to 0? It's too many ifs, right? Be an algorithm. A trading algorithm, if the strategy rules are respected, they fire off the trade, right? That's why I fired off the Apple trade, the Amazon trade, and so many other trades were available on the table with a very wide margin of safety by the Friday expiry on stocks that potentially you liked a lot. So hopefully you guys were able to find some short put opportunities in the markets today, because there wasn't a lack of them, but maybe you were a bit trigger shy because of, you know, external factors like media headlines or your own possible, your own possible view of the market or stuff like that. Try not to predict too much, guys. If it's a stock that you like, and the level respects the rules, it has a very wide margin of safety, it's possibly oversold short-term timeframes, it's into a very large support level, the valuation is good, and coming back to number 1, you like the stock, right? And the option makes sense down below there, then just take the trade, right? It's a 1-week trade. A lot of these options I'm doing after a 3%, 4%, 5%, 6% decline, the strikes we're writing are another like 10% lower. I know markets can drop, guys, but 10% more for the week after already being down 3, 4, 5, 6, it's somewhat unlikely, and the delta should tell you that. If you're going for like a 4 to 7 delta, it's a 4 to 7% probability. It'll never be 100% success rate. But if I tell you that flip this coin 100 times and it's going to be heads 95 times out of 100, like who would bet on tails, right? If you go to a roulette wheel at the casino and the dealer tells you like the wheel is rigged, like this one actually has 95% odds of red every single spin, like, why would you bet on black? Like you can if you want to, because it's not 100%. Like you'll win sometimes, but 95% of the time I'll win. So those are the trades that I'm going for. So hopefully that makes sense, guys. That's everything for today's video. Hopefully you enjoyed it. If you did, consider dropping a like. Would really appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We'd love to have you back. We do these every Monday to Friday after the close. If you have any questions on the video or whatsoever, stocks, options, macro, always feel free to read them, to leave them down below. I love reading them every single night and answering you guys. Thank you so much for your continued viewership and participation on the channel. It makes these videos very worthwhile to make. And you guys also know, guys, that we do have the Discord down below in the description if you want access to all my trades in real time, the put selling trades, right, for the put wheel, the credit spreads sometimes, the call debit spreads, the leap options, the long-term plays like the swing trades with shares, or otherwise just building long-term portfolios. All the different strategies that you guys have ever seen me do, they're all alerted in our various channels as well. We also do private morning live streams in the morning every 9 a.m., 9:30 a.m. at the open. I trade live and stay with you guys for about 2 hours plus to answer all your questions on your stocks, your options, your trades, your long-term portfolios, stuff like that. If you cannot attend, they're all recorded, or you can ask me all your questions in our relative chat rooms all throughout the day. I'm very fast to answer as well. So if ever you are interested in joining the Discord or have any questions as to our community of over 150 people who have the same trading strategies, the same short, medium, and long-term goals, you just want to be part of a community with those shared goals and perspectives and strategies, well, then the community might be for you, and the link is down below. Hopefully I can see you in there soon, and if not, I guess I'll see you back on the channel, guys. Hopefully you enjoyed it, and I will see you guys tomorrow after the close. Take care, and peace.